Hey traders, this is Blake Morrow with Trader Summit, and with me today I have Mr. Jim Welsh of Macro Tides. It's Friday, and I love bringing in Jim because we get to discuss everything that's happening. Well, it's happened in the markets, but everything that's happening this next week. Big week next week, right, Jim?
It's going to be a crazy week. There's a lot of data. Obviously, the Fed meeting, and markets are going to be hanging on every single word that Powell says in his press conference.
And let me remind everybody, we are at 4,900 on the S&P, where you said we would get to, and I'm like, where are we? And then, I've been a believer now for a few weeks, but you didn't have me at hello several weeks ago. So here we
Yeah,
are. I know we're going to look at the markets, but
yeah.
let's kind of start with what's happening right now. We got the PCE data. I'm just going to bring up your first chart because that was released today. Was there anything in the PCE that really told us that we didn't know?
Not really, and then maybe that's why the market has had a fairly muted response.
Yeah.
In this last Monday's weekly technical review, I showed this graphic and basically said, hey, if it comes in at about 0.2%, this is what the numbers are going to be. We'd see the headline rate drop to 2.6 and the core would drop to 2.9, which is exactly where these numbers came in. I've discussed this in the past. Again, this is a 12-month rate of change. So if we look back to January and February of 2023, you can see for the headline, 90 basis come off. For the core, 90 basis points come off for the next 2 months that we're going to get numbers, right? Well,
Correct.
if the PCE goes up 25 basis points, in fact, it was up, I think, 17 in this most recent month. Well, what will the numbers drop to? Well, the headline number will drop to 2.2. By the time we get that data in late February, or pardon me, late March, and the core will be down to 2.5, maybe 1/10 less. So the point being is this is what's coming. So as forget this meeting of the Fed, when they meet in March, and I can't remember for certain if they will have the February reading by the time they meet, Blake. But obviously, the doves on the Fed are going to be saying, look at inflation's come down an awful lot. Our main metric, the PCE, is getting within shouting distance of our goal of 2%. And funds are up at 5 3/8. We're going to need to bring the funds rate down. It is a valid argument. All right. At the same time, I think the next chart is GDP. And, this will be the other side of the discussion is for the patient hawks, they're going to counter with, yeah, that's great. At the same time, the economy seems to be operating just fine. Thank you very much. And the idea that well, two things. First, this tells us we can be a little bit more patient before lowering the funds rate and adding even more stimulus to an economy that's already, performing better than we all expected.
Yeah.
And so to me, that is one of the counterpoints between the doves talking about the inflation data. They have a legitimate argument in terms of the real funds rate being pretty high. And then the patient hawks saying, yeah, but the economy, despite the fact that we have tight, a real higher funds rate, the economy continues to chug along at a pretty good clip. And then lastly, the next chart is of financial conditions. Now, as I've explained, there's two types of financial conditions. There's the financial market kind of financial conditions, and that's what this chart is of. So in other words, this S&P going up, treasury yields coming down, dollar softness, spreads between government and corporate bonds tightening. That's financial market. So what we've seen is financial conditions have eased very significantly, certainly from where they were when the S&P was down around 3,500
Yeah.
last year, okay, or pardon me, 2022, and they're almost back basically to where they were before the Fed started to actually raise rates. All right. That provides stimulus in terms of mortgage rates are down, wealth is up. Now granted, that helps a very small percentage and segment of our economy, but it's real. And so the patient hawks can also point to this, that wait a second, the markets are providing stimulus via how they behaved in recent months. And that to me makes it, again, a tougher decision. I still think, and we've got a bunch of data obviously between now and when the Fed meets in March, that Powell, if everything was exactly where it is today, would argue that we need to be a little bit more patient and wait a while. The other thing I said, there's two types of financial conditions. The other one is Main Street financial conditions. So if you're a small businessman, this easing of financial conditions, Blake, hasn't helped you at all.
Sure.
You're playing prime plus a spread, and without the Fed lowering rates, you haven't gotten any benefit. Personal loans, car loans, and so forth. So on Main Street, they're still feeling, the tighter financial conditions as a result of what the Fed did. So I think when Powell talks next Wednesday, he will be a true two-handed economist, Blake. On one hand, inflation has really come down, and we have to acknowledge that, and it's all welcome good news. On the other hand, the labor market is still really pretty tight. Wage growth is still way above what would be considered appropriate for inflation continuing to really come down and then stay down. And that's what I think he's going to do, is strike that balance to leave open, in other words, be completely non-committal and basically punt until the March meeting. Now, how markets are going to respond to that? Obviously people, well, I want him to hint. Well, I think he's going to give both the patient hawks and the doves their due.
Okay. So with that being said, now before we get into your charts, so you can show us what you think the reaction function is going to be in the markets, make sure you guys and gals, if you like what you hear from Jim every week, make sure you give him a thumbs up, subscribe to the channel down below so you don't miss any of this content, and jump in and comment to Jim if there's something that maybe you want to comment about regarding financial conditions, because I mean, look, house prices are up, my portfolio looks great, I feel good, I'm spending. Is this going to be working against the Fed at this point, as they're trying to reach that last benchmark to get inflation where they want? I guess that's really the question.
Again, their perspective is not so much 2024 as 2025 and 2026. Gee, if we start cutting rates a little too soon, are we going to see inflation, pick back up next year or beyond?
Yeah, interesting. Okay, well, the next chart that you brought, the first one as far as the markets go is in gold. So what is this gold market telling you, or what is your analysis telling you about gold and where it should be going?
Well, think about it. We got a PCE number, which was constructive, and certainly give heart to those who think the Fed will be cutting the funds rate. The dollar was a little softer and gold is down. I mean, again, that trend line break that we talked about last week, I think is important. Now, granted, it did briefly cover back to it, but if we're going into the third of the third, which is the bullish count to the upside, I don't think that break should have happened. That opens the door, I think, to a deeper pullback. And to me, a drop below 1974, pardon me, seems really likely, Blake. And potentially, 1933. In other words, we're going to see, I think, a stair-step pullback in gold. And, there's a lot of people that became very bullish. My take was, once we had that key reversal at 21.22, you only had 3 waves up. Wait a second here. That throws a little fly in the ointment of, oh, we're going above the old highs, going to 2,300. That caution because of that, I think so far has played out appropriately. I think there's an outside chance that gold could retrace all the way down to 1812. Why? From the decline from the May high last year to that low would be wave A of 2. Big ABC up for B of 2. And now we're talking about wave C of wave 2, taking gold down below 1812. That is a viable pattern. It cannot be ignored. So when I look at things, it's like, it's not acting great. It didn't run when the dollar was weakening.
Yeah.
And, it just is not performing well,
Right.
whatever the reason. All right. I did send a chart of the dollar. I don't know if you got that or not.
Let me
Sure.
check, and I do see the dollar. Sorry, I guess the dollar you wanted to talk about first. That'd have been my
Either
fault.
way.
So there we go.
No, don't worry about it. Either way. So to me, again, in late December, the idea was we're going to see the dollar rally. The economy is going to be okay. People are looking for all these rate cuts starting in March. There's going to be pushback against that. That's what happened. I think the dollar still should at least get above the recent high in the last week of the 103.81. And that wave 4 of lesser degree, there were several days up around 104.20, 25, 26. It just looks to me, Blake, like you're going to get a pop. If Powell is non-committal, doesn't give the people who are, okay, he's going to confirm that they're going in March. If he really doesn't do that, that might be what will provide that pop to the 104.20-ish level. So to me, I think there's more upside longer term. Eventually the Fed's going to be cutting rates. And it'll be a combination, I think, initially of, okay, we got to give the doves a bone. Yeah, the real funds rate is high. They will cut the funds rate. And then as we get to mid-year and beyond, I think there's more cuts coming because the economy is going to slow materially or geopolitical risks take over.
Yeah.
I mean, I don't know how anybody can look at this world and conclude that it's getting safer, calmer. I don't think that's not what I see,
It's a great point.
And a lot of times, what triggers recessions is things are slowing a little bit, and then all of a sudden something happens, and you go into a recession. Geopolitical, in 1973, oil prices went from $3 to 12. 1990, Saddam invaded Kuwait. And I mention those 2 years because those are 2 years of the 17-year cycle that we talked about. Every 17 years going back to 1939, the S&P has made a top and then dropped by more than 20%. But 17 years from 2007, this year.
That is this year. It is. If anybody has a calculator handy, you can figure that one out too.
Yeah, you can do it longhand.
All right. Yes. Longhand. Who does that? Just you, Jim. Just you. All right. So the next chart you brought is Treasuries. So what are we looking at here?
Well, again, you got 5 down from the highs last October. That implied that we were going to see Treasury yields move up. I think we've seen wave A, wave B. I don't think wave C is complete. The target around 430, 425 seems reasonable. You got a good PCE number today, and bonds haven't done much with it, which implies to me that there's more upside to come with Treasury yields over the next few weeks. And again, maybe it's Powell, as I said, a two-handed economist, doesn't give the doves what they want. And the bulls, both in terms of Treasury yields and the S&P, and we see yields tick a little higher. Once this retracement is complete, I believe we're going to see yields drop again, take out the lows that we made in December, and I think approach the lows from last year in April, which on the 10-year was about 3.25, and I think about 3.45 on the 30-year. And again, what causes that? Economic weakness, Fed easing. What could cause that? Well, the economy slows down because we had the greatest tightening and increase in lending standards in the last 40 years in the last 20 months.
Yeah.
Or a geopolitical event.
Well, let's see what could do that. So,
Yeah.
all right. Well, Jim, next chart is the S&P. So, here we are, 4,900.
Yeah.
It seems like dips are really shallow. People are buying. Can we get to an accelerated period of the markets? I mean, could we
Yeah.
I mean, is there a risk of a blow off top? I think there is. I mean,
yeah. No, I mean, again, the news can't be more supportive. The economy's okay and rates, the Fed's going to be cutting rates.
Yeah.
Doesn't get much more bullish than that. So far, you've seen a little dip off of the 49.03. Then today's high is 3 waves. That's why potentially we could see a dip to complete again. I think from the lows of January 5th, we've got 1, 2, wave 3, and we're in wave 4 potentially. That would allow, unless we accelerate later today, a dip. But I don't think we should take out and close below that prior low, which was around 40, I think probably 48, 45-ish. You can always take things out by a tiny little bit.
Yeah.
But so my expectation, Blake, is I think we get a little bit of a pullback. There's still going to be one more push up, maybe into Fed Day, before we've got 5 up from January 5th. And there's still a lot of technical negatives. There's an RSI divergence so far on the S&P.
Yeah.
With new on the daily chart, and there's a bunch of stuff. So anyway, I'm just trying to navigate the very, very short term and maybe I'm trying to fine tune it a little too precise, but the Russell could provide us a clue. And that's why we're going to look at the Russell 2000. What we can see is you had this big pop over the last week and a half in the Russell. It stalled out at around 1990. Traded 2 days. It traded above it, only then to pull back quite a bit. If the Russell can get above and close above 1990, and I thought that a good PCE would help the Russell do that, that would imply then that the Russell runs more, maybe gets even close to the 2072 high. But if that's going on, I think obviously the S&P is going to be participating.
Yeah.
And that's why another reason why how we could still get another push up in the S&P for what I think is wave 5. Conversely, it closes below 1955. Then all of a sudden it's like, hey, it's tried so hard to break out above that 1990 and it's failed. So again, sometimes looking at other averages can provide insight as to what may happen in the overall market. Again, you had 5 down from the high last July last year, clear 5 down. So in late October, that was one of the reasons why I thought the market was setting up for a rally to at least 4,500 on the S&P. So looking at these other averages can be really helpful in terms of getting a clue about what the broader market might be about to do. So
that makes a ton of sense. So let me ask you this, and this has nothing to do with technicals, but we've got, well, I don't know what, maybe 20% of earnings have come out thus far, somewhere roughly around there. What's your take on earnings season thus far?
Well, we've seen some. I think it's surprising people that a lot of the companies come out so far have kind of underwhelmed, and those stocks are getting punished really pretty hard.
What's underwhelming already cut or revised lower earnings expectations for the most part.
Yeah,
generally speaking.
Yeah. At the same time, I think that the big company stocks are going to hold the key. Are those stock prices already reflecting whatever the numbers come out and people choose to sell into a good number? That will be, I think, a very important tell. and the guidance. It isn't so much the numbers as guidance. And I think
Yeah.
that's what's tripped up a number of companies that have gotten pounded, is that the numbers weren't terrible, but the guidance wasn't very positive. Um, so we've got a split market in the sense of we've got some averages making new all-time highs. Well, the Russell is still 19% below its all-time high. The value line is, I think, 16%. So you really got a bifurcated market. We've got the economy doing pretty good. And as I wrote about in this week's weekly technical review, is on one hand, consumers are spending, but there's a portion of consumers that are funding it with credit card debt and buy now, pay later loans.
Yeah.
You know, I'm saying, so to me, the increase in asset values have become a linchpin of supporting economic growth. If we go into a prolonged bear market and I believe a secular bear market is coming that will last 10 to 15 years, I think the S&P during that secular bear market can drop to 1,600.
Wow.
Why? Because the highs in 2000 and 2007 were 1555 and 1575. So going back down to those highs is chart-wise pretty like, well, that's what should happen.
Yeah,
Almost,
yeah.
all right?
It's like a basic TA, right?
Okay. I'm working on the February macro tides, and one of the things I'm going to lay out is, if I'm right, that after we hit a low in treasury yields sometime this year, that the 10-year is going to retrace up to at least 580, maybe 740. Well, what does that do for mortgage rates?
Yeah, it's gonna be crazy.
Housing prices are already ridiculously out of reach for so many potential buyers. So the point being is, in the coming secular bear market, we're going to see wealth evaporate, both in terms of equities and housing. And that is going to feed into sub GDP growth for an extended period of time. That's what's coming. All right. Now I'm just trying to figure out, all right, how do we navigate the next few months, and potentially, which could include some kind of a blow off top, going into, hey, the Fed is finally cutting rates and all that. And the lack of selling pressure. There is no reason to sell right now in most people's minds. Individual stocks disappoint. Okay, let's beat the heck out of them. But the overall market, it's like, no, we got everything going our way. The economy's still good.
Yeah.
And the Fed's going to be cutting. So you're right, Blake. The potential for a blow off top in that kind of environment can't be ignored. That's why I think you have to be careful. At least I'm trying to be careful in terms of saying, okay, it's time to go short.
Yeah. Yeah.
I don't want to get blown up. All right.
Right.
Now,
right.
So the next few months are going to be really, really critical, because we're at a turning point, in my view, an inflection point sometime this year that is going to then influence maybe the next 5, 10, 15 years, not just in terms of financial markets, but our economy, and then ultimately, obviously, our society.
And maybe 17 years.
Could be.
Well, guys,
it's going to be way longer than any of us want to
right, exactly.
endure.
Well, guys, I just want to say Jim's gave you a lot to chew on this week, and if you really enjoy his stuff, make sure you reach out to him and request his most recent technical review, which came out earlier this week. I got it on Monday. Yep. I believe it was Monday. How do we do that, Jim?
Well, go to macrotides.com. And obviously you can subscribe, and there's a 50% off for the first month, so that you can kind of test the waters, and that's kind of beneficial. Or send me an email, jimwelshmacro@gmail. And since I just hinted at, again, the secular bear market thesis, I have a piece that entitled "The Coming Secular Bear Market" that goes into much greater depth in terms of why things are starting to align for that to take place.
All right, Jim. Well, I tell you, I appreciate having you here every week, and I know everybody else does. And if you do, make sure you give Jim a big thumbs up. I want to say thank you so much, Jim. I look forward to catching up with you next week, and
All
good
right.
luck navigating next week's madness. We got
Should be boring.
the FOMC quarterly refinancing, all sorts of stuff happening.
Stuff.
End of month
Yeah.
flows. Holy cow.
Who could ask for anything more?
Just traders, baby. That's all we care about. All right. So thank you,
got it.
Jim.
Thanks, Blake.
I'll see you next week. Thank you.
You got it.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.